All right, good morning, members. It's LA. It is October 11th. This is the weekly review, and what a review we have. A lot of stuff happened last week. In particular, we finally have what looks to be a more serious breakdown in these markets. I'm going to spend a lot of time looking at that, speculating about what that means. But as you can see here, just looking at the numbers, huge downdraft last week, worst ones we've seen for 3 years. And Russell now almost 10% down. Dow went negative, and you're just barely up now on the other indexes. So all those gains that we've been sporting, all that deterioration that we've been seeing, that we've been talking about, that we've been looking at, that we've been concerned about for the last 2-3 weeks now in particular, starting to come to fruition. We're starting to see a serious breakdown here. So I got a lot to cover. Let me pop into this. Last week I said in particular, we may see a bounce. We saw a bounce. It's highly likely we're going to see more downside action. We're not done. I didn't know that it would come immediately. I actually thought we'd probably work a little bit higher. I thought we'd get at least a sideways move for a week or two. Not to be. That was the danger, right? I even got sucked in on that IBB trade on Thursday off those Fed minutes. Bear markets have ways of just taking your money away. It's like a death by 1,000 cuts. You'll get these big spikes, and then next thing you know, you're right back down at the lows again. And that's kind of what we saw. So, the technical picture is bearish. It's starting to turn bearish. That whole bearish case is getting built out. And we'll go through a lot of numbers here and you'll see what I'm talking about. Let's just pop into, I've been headlining these things with the technical negatives and positives. If you look at the negatives, they got worse. And they should, right? We're down 4% on some of these indexes. The Russell 2000 has completely broken down at this time frame. So let's pull it up and look at it first, right? We had an ABCD structure still in place. We talked about it being a monster-sized one, and it was, and it still is, right? And it hasn't completed, but it's close. It's another 0.5% down, and so you got this move down on the Russell that is in place, in progress, and it's about it's getting close to done. That is on top of the weakness that we saw on the weekly time frame, right, where we had a breakdown last week, right, that told us, boy, this could get bad. And this week, it did get bad. Confirmed bearish trend now on the Russell, and what's worse is all these swing points broke now, every one of them. And that whole range up there now is distribution. It's not accumulation. You never know until it's over which one it is. You can speculate, but it is most likely distribution that took place now. In other words, they pop it up here, they distribute away, they being the large institutions, the large players, distribute away their stock, feeding it to the public, usually is the way it happens. And then eventually it all starts to break down, and when it does, it typically escalates. In other words, if I'm distributing up here and I'm selling some and then I buy some back to pop it back up, and then I sell some more and then I buy a little bit more back, and so I'm slowly getting rid of what I have, my inventory. But when I get towards the end, and if I make that decision that I can't get rid of the last 500,000 shares I have, I start dumping them. And I don't know that we got quote-unquote the dump here, because we're only one bar below it now. This thing could pop right back up in here next week, and, we just built out a little bit lower of a range. But at this point, we have broken multiple swing point lows, and when you do that, right, it's typically 2 to 3 bars to the downside on that time frame. That happened last week. We're already bar 1 on last week's, but now we go under a bunch more. That means we've got 2 to 3 bars to the downside. That it doesn't mean that we have to go lower and lower. We can just trade sideways. but it does mean that you're more than likely not going back higher. So, that's the scenario. This looks like its distribution. And if you take this range and you project the range down, right, that becomes your larger target on the downside. And if we look at that target, that number's fairly low. It's down around, I think it's about 1010. Actually, it's lower than that. It's down around 940 or so. So it's a large break to the downside. You went from 1213 down to this low. Well, if we take this low over here, which is the lowest one, so that's 160 or so, and then you project that down off that low, that takes you down to 950. So the 943, 950 area is where this thing probably wants to go. And then what's worse is if you take and pull over the monthly chart, okay, and let me just clean this up and bring the monthly chart over. Guess where your swing point low is on the monthly? It's this bar, 942.79. So this range breakdown, from this area down, right? Well, let me draw it in differently here. This little breakdown here is projecting another move down into this area, and that swing point low is just up underneath there. So as you can see, we're going to get close if this projection works, which I think it has a pretty good possibility. And we're on the monthly now, so it's going to potentially take a while to get there, but it's going to project down to try to go after that swing point low. And folks, when you start looking at these kinds of breaks, these are huge. They're not small. And matter of fact, I put a lot of notes in here this week, and I'm scrolling down here. I put all the historical trend transitions over the last, 5-6 years. So on the intermediate term time frame and on the long term time frame. So you can see when they last broke and what that looked like. And if you go back to the 2008, 2007 period, you can see how things began to break, right? Like here's the SOX breaking, and when the SOX is starting to break now, you can see in 2006 what led it down back then. SOX was one of them. And you can kind of see how that broke down on intermediate. Now if you go on down, I've also got the long-term time frame in here for you. You can see the GDX is the only one that's broken so far on the long-term time frame. That was back in February of this year. If you go farther back, the last time any significant breaks took place to a bearish trend was 2011. That was 8. Here's the steel industry, the broker-dealers, real estate. All of those broke in 891. Now, if you remember, and the reason I'm showing you this is if you remember, and if we pull back up the chart now, that break on the monthly back here, right? Those long-term trend transitions, and when they took place, you got the turn shortly after. And so the reason for pointing this out is if we get those trend transitions and we see them actualize, then what can happen is you can get the crash situation, which was the 2008 transition, or you can get the deep retrace, which was the 2011 transitions. So just because they transition on the sectors does not mean the indexes will. Okay, so that's one key thing to keep in mind here. In other words, we don't have to get a crash. We can just get a huge correction, right, on the long-term time frames. And if I go look at the actual, I think I have it here, or maybe I forgot to put it in. I'll add it. It looks like I didn't put it in. I only put the sectors. I'll put the indexes in here as well. But on the indexes, they never did transition. And if you think about it, and I've talked about this before, the way this thing works is the stocks themselves start to break down first, then the sectors, and there's time in between these, and then eventually you can get the market itself, the indexes. And so when I'm talking about, the trend transitions, we've already clearly got this going on. This is already happening. So we've already got the transitions taking place from here to here. What we don't have yet is we don't have the trend transitions taking place here. We do have this, and I actually have more data that I could share with you, but we do have this taking place on stocks. We're already seeing some of the long-term trends transition on stocks. We have none of that taking place on the sectors yet on the long-term time frame. We do have it here on the intermediate term time frame, and I'm switching between the stocks sectors market, because you can also have the exact same picture on a stock short term, intermediate term, and long term time frame, right? So we have some stocks that are over breaking long term trends. As that happens, that puts more pressure on the sectors to start breaking here and potentially to break over here on the long-term time frame. If I look at the sectors then of course drive the indexes. The indexes right now, you've got two of them that have broken on the intermediate term time frame. You don't have any that have broken on the long term. You don't have any sectors that have broken on the long term. So you can see the progression is towards breaks, both on time frames and in terms of breadth. And that is starting to happen, but just because you break on the intermediate term time frame doesn't mean you'll break on the long term, and it certainly doesn't mean you'll break in terms of the breadth, the sectors and the indexes. But that is what can happen. If it does, it's going to take a while. It will take a while to play out. And I can probably show that to you nicely here, because if you look here in 2000, and this is the long-term time frame, right? 2007, which one broke first? Real estate. Just what you would have thought. Then what? Stocks. And look at the times. This is early 2008. This is before the crash. The crash took place here. So the first one to break was more than a year and a quarter before the crash. That was the real estate. What's happening right now? XLE is the leader right now on the downside. So the XLE is acting like the IYR back in that time frame. And if we're going to get a big crash, when we look back 4 years from now, we'll see the XLE taking this spot. Then you had some others start to join. And remember how I always talk about when you get 2 to 3, pretty soon they all join. Well, that's what happened, and eventually this. And this is long-term stuff. So if that's going to happen, it's going to take a while. So we're not going to see a crash immediately. We can see 15, 20%, but not 40 or 50 immediately. It's just not going to happen. It doesn't go that fast. It takes time. And that's even if it's going to happen. We don't know that, right? We're way too early in the game to know that. So I'm sorry I digressed there, but I just think it's important that you think about what could happen and realize that, there is definitely a change of character here. It doesn't mean that, we're going to crash. It just means we can. We're setting up the structure to allow it, and we'll have to monitor it and decide. And I've got a lot down here about, when we get down to our portfolio, I got a lot there about how do you protect against that, because I think that's important. So let's quickly keep going here. Russell is broken on the intermediate term time frame now. So if I pull the Russell back up, and look at it, you've got a trend transition. This is the daily. If I look at the weekly, you got a trend transition now on the weekly, right? We've broken. Now we've got huge supply up above us. Anybody that hasn't got out, any kind of pop-up, they're going to try to get out. That's going to put huge pressure to continue to the downside for a while. NASDAQ has now joined the Russell. Remember, I always say 2 to 3. Here's number 2, and we're only talking about 5 indexes, so this is major in my mind. Breaks, swing point low, volume expands, big push down. NASDAQ now has joined. That tells me this is for real. It's not just the Russell no more, folks. It's broad. It's broad, and you can see that if you look at individual numbers, as to how many stocks are going down and so forth. I didn't share this with you, but I'll give you the numbers. 72% of the daily trends on all the stocks, 72% on the daily, on the short-term time frame, are bearish now. 72. If you go out to the weekly, 50% are bearish now. Half the stocks are in a bear trend on the weekly already. Now, if we go out to the monthly, of course, it's not there yet. We're only about 20% of them. So you can see that transition taking place, and it's massive, right? It's broad. Most stocks in a bear market will go down, and that's what you're starting to see in the numbers already. That's the NASDAQ. Intermediate term time frame sectors all starting to change. Remember last week, most of these were still bullish. Well, there's only 3 left now. You got the utilities, which are a safety play. You got the healthcare, which is still holding up. And you've got the financials, which are on the brink, but still holding. Everything else transitioned. We got bearish on energy, and then we got sideways to bearish on everything else. So you can see all bearish over here almost, except for what? Utilities and consumer staples, the safest things. So even though the money doesn't want to leave yet, it's definitely rotated into safety. Everything else went bearish. Out here, long term, nothing's bearish yet here or here, but now you have the trend transitions here and you're going to bearish there. So you can see that the weakness here now starting to bleed into these. So the stock weakness had already taken place, eventually led to this, now leading to this. That's how it works. If this continues long enough, then it will start to bleed into these. And it definitely will start to bleed here first and then into these right afterwards. So that's the rub here. Folks, when you get the breaks here, if they go long enough and you don't get the push back up, eventually it will bleed over into this area. It has no choice. It's just the way it works. And so that's the next piece or the next leg down if it's going to happen. And that's where we'll have to be watching. And again, it will take a while for it to play out, but that's the way it will work. If we go now, oh yeah, let's look at this, the XLE. So let me pop over to the sectors here and grab the sectors and show you the sectors on the XLE here. So the XLE, as we were just talking about, is kind of the sector canary, if you will. This one, huge, just total wipeout, big volume expansion, right? We were talking about this is big volume expansion when it first hit. Well, look at it now compared to what happened on Friday. Blowing these things out. Now, is that going to be the largest that we're going to see? I don't know. All I know is that this thing can't find a bottom and it continues to grope for one. Here's the blowout on the weekly. And what's it doing? Coming after the swing point lows. These swing point lows at this time frame are the monthly swing point lows. That's this price point. Look at the volume here, 298. What are we coming into it with? 239. What part of the month are we in? We're only halfway in. This thing's going to do 400 and something into 239 to 300. It's doing 25% more volume after it, as it comes into the swing point low. It's going to try to break it down, folks. It's going to be the first sector to break on the long-term time frame. It's going to be the first one that goes and transitions here. Okay, that's not as concerning, except it's not the only one that's close. For example, if I look at the XLY and bring it on the monthly, the XLI is not all that far away. Price point here, 6103. What's it there? 64. We're talking about another, 3, which is 0.5%. So 5, I mean not half, but 5%. 5% lower, it breaks as well. The other one that's even closer is the XLY. XLY, if I take it, sorry about that, let me grab this one, monthly. If I take it, XLI, the industrial sector, the low there, 48.38, we're at 50.32, we're talking about $2, that's about 4% away. So 4%, 5% away, XLE is like a percent away. That's to break on the long-term time frame. In other words, to move back from bullish to sideways. Sideways is an intermediate term place, right? It's a transition phase. Either you're transitioning lower or you're going to bounce back higher. But when it transitions, it tells you there's broader weakness taking place. If they transition on the sectors, you get 2 to 3, usually you're going to get more. That's the danger, and that's what we'll have to watch over the coming weeks. All right, so let's go back to the notes here. This is a major inflection point, and these are the negatives again. We talked about the volatility many times, signaling that that's exactly what has happened. We didn't know if it would, but it did. Those inflection points, when they start to break, they're large because they typically have large ranges associated with them. So if I go back, for example, not here, but let me grab the other screen. If I go back over here to the general markets and I pull up that NASDAQ again, the composite, and put it on the weekly so that we can see a little bit longer time frame. On this weekly, if I draw this out, right, you have this area was a range. Now it's trying to break down into the lower range. And actually, if you draw this a little bit different, and this is always kind of, how far do you draw it? I would draw it to there potentially, because then it becomes about equidistance, which is what I like to see in these ranges. If that's true, this one's just got into the top of the lower range. If it's going to the bottom of it, it's going to about 39.73. And guess where that is? That would be a dual swing point transition on the weekly to bearish if it breaks. So if we go all the way down there and break, right, you can see a major top starting to take place. Now, let's take it a little bit farther, and I don't do this much anymore, but if I'm a classical technician, I would be looking at this. If this happens, right, if we come all the way down here and then come back up, I would be looking at sort of a head and shoulders major top, potentially. And that's usually the way these things play out if they're going to. In other words, you come up, right, you come down, you go back up, you come all the way back down, then you go back up again. It's the failed bounce that's the killer. Because if that really happens that way and this rolls over and starts to break, that's when you can get huge downside. And we're talking the 40 for 50% stuff. So, just realize it takes a long time for these things to play out when they do, if they're major long-term trend changes. And it will take it a while. It will take it another 5-6 months probably. Just like we looked back at 2007, how we saw some of those transition early as warning signs. And when you see that, you have to realize that you could get a torrential storm coming at you. And you have to be, cognizant of that and preserve your capital if in fact that is what happens. And hopefully speculative plays on the downside if in fact that's the way it works out. The other thing that has started to take place here and that we need to be aware of is the junk bonds. Junk bonds have high yields. People flock into this as a place to go get yield. They can't get yield anywhere right now, right? Anything that has to do with a bond, you can't get yield. Junk was one of the last places you could do it. There's high quality junk and there's low quality junk. This is the lowest quality junk. And you can see here on the daily how it broke down. Volume expands tremendously. It goes to bearish. If I pull up the weekly, on the weekly it has broken as well and gone to bearish and volume escalation. This is going after these lows on the weekly. If I pull up the monthly, right, the monthly has transitioned to sideways already. I suspect, it's going to come back after this low before it's over. And by saying before it's over, I'm talking about in the next few months. And so we're going to see more pressure probably on junk bonds. That also is a definite signal of be careful, right? Because junk bonds typically are the leaders, when you're pressing to the downside. So that's another negative that I see out here. If I look at, talking about junk bonds, let's go to those safer bonds, which is the LQDs. This is the investment grade. These don't look nearly as bad. So they're still holding up well. So we don't see massive fear. We only see it in the junk grade bonds at this point. This too will break down if we really believe, if the market really believes that the potential for a major break, bearish move is in the cards. These will break down as well. So right now, you can see here, that's not happening yet. Last thing, dearth of bullish trading signals. When you look at the trading signals, and I haven't, talked about this a lot, but it's just another one of those tools you can look at. If you look at the trading signals that are being generated right now, and I take, when I come in here myself, and there's so many that it takes a while for these to even draw. I mean, that's how many there are. Usually it's immediate. If I take and I filter it just on anything over $5, and where the volume is greater than 500,000 shares, if I do that, I end up with quite a long list, a very long list. There was one bullish signal. Everything else was bearish. And not only that, when I go through this list, what I'm looking for, I pull up, say, AAL, the airline, and I'm looking to see, is this thing potentially going to continue? In other words, are the probabilities pretty good that it's going to continue in a bearish move? If so, then I take that, and I go back up here to the watch list. I take that, I take and drop it into the watch list for you as a bearish signal on the trading signals. Folks, I put 98 of them in here today. That's how many look as if they're going to continue lower. You can see them, they haven't been drawn out yet. They haven't, the programs haven't come around and filled out the details yet. 98. I haven't done that in a very long time. Now, it tells you two things. As a matter of fact, a lot of this tells you two things, and we'll get to that in a second, but that tells you two things. One, very bearish. Two, we're starting to wash out, right? We're going to get some sort of a washout, fairly large bounce at some point. Now, that's anecdotal. You can't time off of that, and I wouldn't suggest you try that. But that does tell you that, it's getting pretty negative out there. And when it gets pretty negative, at some point, it will bounce. It's just the way it works. Positives. There are some positives. The greatest potential sustainable turnaround for me right now, that catalyst, is earnings. Earnings start up in a large way this next week. You got the financials. You've got the, well, actually mainly the financials. You have others, but those are the big ones. And when that takes place, those financials, right, had better not only hit the mark, but tell us that things are getting better, not worse. If they don't, right, that catalyst is not going to happen, and that to me is probably the largest sustainable catalyst. In other words, we could arrest this whole move if those earnings really look good and if the projections are good. I don't think that's a high probability, so that is a potential positive, though, and we should watch those closely this week to see how they turn out. The other one that can happen at any point, and it's already starting to happen. I was amazed. I pulled up the news last night, and I'm already seeing all these minions, right, these Fed minions going out and saying, oh, we can't raise rates because so far everything is projecting to summer next year we're going to start raising rates. Well, we can't do that. Remember, we saw that already with the dollar getting stronger. Well, that's part of what's going on, but now they're just talking about the world market's getting weaker. We can't raise rate if the world's getting weaker. They're never going to raise rates. It's how can they raise rates? The first thing we're going to see between raising rates and more QE is we're probably going to see more QE. I said that probably a month ago, 3-4 weeks ago. QE is not going away. We are stuck in this perpetual nonsense of trying to generate growth, right? artificially. That's not the way it works. It never worked that way, and it isn't going to work that way now. Yeah, short term, and short term being a few years, you can make it look that way because, economics, a lot of economics is just psychological. Is what do people think? Do they think it's going to be better or worse? Well, if they think it's going to be better, they're willing to spend their money. If they're not thinking that way, they're not going to spend their money. And people are not spending their money because they're worried. They're still worried about what's coming. And that's a problem. That's what the Fed has been trying to do with, propping up the equities, propping up all these things, trying to create that sense, right, of confidence so that people will spend their money and the multiplier effect would take place. Hasn't happened. Isn't going to happen. You can't force it. We have too much productive capacity, in my opinion, and we don't have the demand for it. Now, maybe that will change, and it will change at some point. But, I don't know. We're perpetually in this nonsense, in my opinion. And, I could be totally wrong. I'm not an economist. But, common sense tells me that you can't force these things to take place in a sustainable way. Yeah, you can move the needle for a while. But, they've been trying to create the wealth effect. I am certain that you're going to see the Fed and all its little minions out there and central banks around the world, talking up the need to keep interest rates at zero. It's not gonna change, and you can probably get a spike out of that. The real problem, and this is a digression. Man, I'm way over time, so I'm gonna have to hurry up. The real problem is that if we start losing confidence in the Fed, look out, right? Because so far they've looked like God again, and I'm sorry to use that term, but I mean it's like they're godlike. They can't be wrong. And where else can you have an organization that creates its own problems and then rides to the rescue? It's crazy. The fact that we are starting to see fear rise finally. That's what I was just talking about earlier. Let's keep going here. I'm not going to pop up much more. I got to get through this. I've already talked about most of this. The defensive staples are the only ones that are up. We're seeing all these others transition, and we're starting to see these potentially break down on longer term time frames. World markets. We saw about a month ago deterioration start to take place. Hasn't changed, and it all happened when the dollar started spiking. That doesn't look like that's going to change to me. That's another negative. Fundamentals, there's a bunch of data out this week, mostly price indexes. We've also got some data out in the U.S. Wednesday, Thursday, Friday. Actually, Wednesday, Thursday. But, the earnings are going to be the deal. And down at the bottom here, I've got all the earnings still in here. You can take a look at when those are coming out. Of course, there's other tools you could use as well. Geopoliticals got pushed to the background. It's not the news anymore. Bottom line, let's be very clear here. We haven't seen a significant market downturn for 3 years, right? 2011 was the last time we saw it, summer 2011. It's over. It's actually over 3 years. It's not almost, it's over. So I'll just type that in. If you are too long, folks, you've got to use any kind of bounce to start narrowing down your risk. If you haven't done it, I've been telling you for 2 or 3 weeks. You saw me do it in the portfolio. I got rid of all the trades that were risky. Most all of them. There was only one left. I've abstained from any kind of large trades for any duration. We made some money on the Qs. We lost it on the IBB. You can't trade these bounces very easily. We do know now we have a transition. If you haven't done anything to protect yourself, I can't say it more strongly. You need to protect yourself. It's about protecting your capital until we see a change of character in this market. Yeah, we can trade speculatively long or short, but it has to be a spec trade and it has to be in and out. You've got to time it well if you're going to make money. The trend is now down. So anything you're buying to the long side, what are you doing? You're counter trend trading. Those have to be short and fast. And your timing has to be good or you're going to lose money. Where's the easier trade? It's to trade with the trend. It always is. And that means that we need to start thinking about the downside, which brings me to the portfolio. And this whole thing about, okay, how do you position yourself, right? And I want to quickly go over this. You know, the first thing you do, and I'm going to go straight into this area, and you can read all this if you want. Core positions really, when I talk about the portfolio, I got trades and I got core positions. Trades are things that you want to be in when the market's strong. Either way, up or down, you're trading it in the direction of the trend. Core positions are something that are long that you think are going to be good over time. When things get bad, you've got to get rid of the trading positions, the long ones, right? And so when I go into here, you stay long and strong until there's warning signs. And we saw warning signs 2 or 3 weeks ago. You saw me get out of the trades. In other words, you narrow down, protect yourself just in case the sprinkles become a storm. As the warning signs arrive, you peel off those positions, right? And you get down to your core stuff. That's how you bring down your risk, and the percentage that you're invested in is your risk. So you bring it down, you get it down to something to where you're not going to lose a lot of money. If these warnings turn into actual breakdowns, which is what's happening now you need to start consider hedging those core positions. So if this market turns and spikes back up, we're going to want to hedge those core positions. Now, if it goes straight on down, it's a different story because you've already missed that opportunity and you just have to bear with it. And we're only down, we're only down 30%, to a size of about 30% core positions right now. So we're not going to get hugely hit. But if this market, washes out, it's going to be painful. If the long-term sectors start to change, and we talked about 3 of them, XLE, XLY, and the XLI. If those start to change, right, then we have the possibility of a true bear market, something that's going to get very significant. There you can see 30, 40, 50% losses. That's when we have to be very aggressive in shorting and in cutting back our core positions. So if you think about, this is kind of the way you transition. And if you think about, I think it logically makes sense, and it's the way you have to treat these things. You can't be jumping in and out of your long-term positions or you'll never be in them. You have to wait until it's proven that they're no longer the place to be. But that doesn't mean you have to wait until you take a 10 or 15% drawdown. You move other stuff out early. That's why you have 2 sectors to your, 2 sections to your portfolio. You have things you're trading, and you have things you want to hold long term. And you have to use that to your advantage. Okay, so quickly popping in here, I'm way over, so I'm not going to go into any of these. You can read the data. Essentially we want to try to sell some on a bounce, and we're probably going to look at potentially doing something else on the depending on what happens, and I cover that here. If we go straight down from here, there's not much more you can do but to wait until there's a good opportunity to take a long position on a good bounce play. And so at this point, it's too late to short anything. If you haven't already started shorting, you don't want to start here. You have to do that on some sort of a bounce, and that bounce can be just any kind of 2 to 3 day bounce. We know the Russell has broken down. We know the NASDAQ's broken down. More than likely, we are going lower. So you do, and I do, want to short on a bounce. If we just plunge come tomorrow, we're not going to be able to do that, right? You're not going to want to short the deeper you go down in a straight line fashion. We were down 4% last week. It's not the place to start adding a bunch of shorts. Now, if we come back up and bounce, that's where we can add them. If we go straight down, then we're going to look for something on the long side when we wash out. And I believe that's the way you have to try to play this. I've got all these trend transitions down here. I'll add in, before I send this out, I'll add in the long-term ones, and then all the data for the earnings are still in here too for the next week or two. Folks, be careful. This is where you can lose a lot of money. You don't want to lose a lot of that money that we gained over the last few years. Be careful. Don't don't sit there and get cut like 1,000 cuts right on the way down. You got to pick your spots, and you actually, if you're going to counter trend, trade this to the long side. Ideally, you just want to hunker down, make sure you don't lose money on the way down, or at least minimize that, and wait for this market to wash out. And eventually, we'll get a better opportunity. Thanks for listening to me. Take care of yourself, and I'll see you next time. Sorry about the noise there. Bye.